Hey everyone, in today's video, we're going to be talking about the optimal way for you to pay your Roth conversion taxes. Over the last few weeks, we've talked about a couple different sources you can use to pay your Roth conversion taxes. We've talked about the benefits of each source as well as the drawbacks. Now, obviously, we know when we make a conversion, a Roth conversion today, we're going to owe taxes. So in today's video, I want to wrap it all together and talk about the number one recommended source for paying your Roth conversion taxes. So we've talked, again, in the last few videos about options 2 and 3 here. First off, we talked about paying taxes right out of your conversion. Now, most people think this ruins the value of a Roth conversion. That's not the case. In fact, this is our base case here. Again, you can watch that video in the right-hand corner where we talk about paying taxes right out of the conversion. The number 3 way that we have here is paying taxes out of your Roth IRA. This can make sense for those that are converting when they're younger than 59 and a half. Okay, and again, we've recorded a video. I'll link to that in the right upper hand corner here. But in today's video, we're going to be talking about paying taxes out of your savings account or a non-qualified account. A non-qualified account would be something like a brokerage account, a joint account, otherwise known as a taxable account. And we're going to talk through why this is actually the optimal way if you have this account set aside for your retirement. So when we consider tax buckets in retirement and figuring out the optimal source to pay these Roth conversion taxes out of, we have to be thinking about the tax liabilities for each account. Okay, each of these accounts has a different tax liability. When we sell investments out of our taxable account, if we've held those investments for longer than a year, they're long-term capital gain, under long-term capital gains rates. From a tax-deferred account, when we make a Roth conversion or we pull assets from that account, it's under normal federal income tax rates as well as state income tax rates. Okay, obviously our tax-free account is what we're trying to get the majority of our money into because it's a tax-protected account. It doesn't have RMDs, and anytime we take money out of that account, it's completely tax-free. It grows tax-free, and it can be withdrawn tax-free. It can pass on to the next generation tax-free. So our goal is to get as much in this tax-free account as possible. So there's really 2 goals that we have then with a Roth conversion. We're trying to, number 1, move money from less tax preference accounts to our tax-free account. But this wraps in with goal number 2. We're trying to move this money from less tax preference accounts to a more tax preference account. But we're trying to do it in a tax efficient way, which means, again, the only way Roth conversions make sense for your situation is if you can pay less in taxes today than you will face down the road. Now, if you haven't seen a bunch of our Roth conversion videos, we have an entire playlist on our Safeguard Wealth Management YouTube channel all around Roth conversions. Okay, we talk about what is a Roth conversion and when does it make sense. We talk about different rules for a Roth conversion. We have a bunch of videos on tax hurdles that you can avoid in the future for, again, why a Roth conversion makes sense today. We have different things on how to calculate out Roth conversion taxes, as well as the timing of Roth conversion taxes. And then over the last few videos, we've talked about avoiding underpayment penalties and paying your Roth conversion taxes out of the right sources. So if you haven't seen these videos, I highly recommend you go back and watch this playlist. Hit the subscribe button. You'll be notified of all future videos that we release on Roth conversions and any other topic we release videos on. So again, this is our goal. Move money from less tax preference accounts and pay less in taxes today than we will pay down the road. Okay, so let's first talk about a very straightforward way of paying conversion taxes out of your taxable accounts. And this is if you have cash or savings set aside. And again, this is very straightforward. So let's say you have a checking account that's $150,000. Okay, and let's say it's earning 0.25%, so basically nothing, especially when you look at it after inflation. This $150,000 is losing to inflation. You are losing money on this each and every year. So there's 2 benefits that we get with paying taxes out of a checking account, out of a cash account. We're moving money that's earning next to nothing, and we're paying Roth conversion taxes, which means we have more of that conversion going into our Roth IRA, being invested for the future, earning a higher interest rate in most cases. The other thing is we're taking money from a less tax preference account and we're allowing a larger conversion being transferred to a more tax preference account. So in this checking account, this interest that you're earning each and every year is taxable to you each and every year. Okay, so again, it makes sense. It's very straightforward to pay taxes out of a checking, out of a cash account. But what happens if we have a taxable account, an individual account, a joint account, and it's fully invested? Meaning that we have to sell an asset in order to pay taxes. And when we sell that asset, it's going to have a tax liability. Okay, well, again, my case throughout this video, and stick with me because this is going to get a little bit confusing as we talk through different tax rates, as we talk through different tax hurdles. We're going to start layering on the complexities. So stick with me through the end of the video as I make a case for this still being the optimal way to pay Roth conversion taxes. Okay, so again, when we think about paying these Roth conversion taxes, we need to think about the different tax tables and cutoff points. Okay, so let's say that we're a married couple and our tax base is $100,000. Okay, this would be after the standard deduction. Our tax base is $100,000 and we have Roth conversion taxes to pay on top of this. Okay, well, if we pull that money from our tax deferred accounts, well, at $100,000 of a tax base, we're going to be paying taxes at 22% on any additional monies that we pull. The other option here is if we have a taxable account, even if we have to sell an investment. Okay, when we sell that investment, again, if we've held that investment for longer than a year, we're going to be under long-term capital gains rates. So we're going to be under a different tax table. Well, at $100,000 of a tax base, okay, any investment that we sell and we have taxable gains on, we're going to be paying 15%. So again, when we're managing whether a Roth conversion makes sense or not, if we're willing to pay taxes at 22%, it obviously certainly makes sense then to pay taxes at 15%. So in fact, once again, just thinking kind of theoretically around paying taxes and where it makes the most sense to pay that additional Roth conversion taxes out of, we'd rather sell a long-term capital gain and pay 15% at the same point versus paying 22%. And you can see across the board at just about every income base that you are at, long-term capital gains will be a tax preference rate relative to tax deferred rates. So if you have an individual account, a joint account, it makes more sense to take from that individual or taxable account rather than taking additional dollars from the tax deferred or paying conversion taxes out of the conversion. Okay, let's dive a little bit deeper into some examples and talk through this. Okay, so when you have a taxable account and you're selling an investment from that account, okay, there is a certain percentage of that that's considered cost basis that you won't owe any taxes on. That's because this was considered the amount that you've already paid taxes on that you used when you first invested in that investment. So let's say that you bought Apple 10 years ago and you paid $10,000 for Apple and it's now grown to $20,000. So your cost basis is $10,000 and your unrealized gain until you sell it is $10,000 as well. So your cost basis is 50%. Well, let's go through an example of, let's say somebody converts $50,000 in the 22% bracket. So they're going to owe $11,000 in conversion taxes. Well, let's say that they sell investments out of their taxable account with a 75% cost basis. So what they're actually going to have to withdraw from their taxable account is going to be $11,430. And how do we get by that? How do we get to that amount? Again, we're only paying the $11,000 in conversion taxes, but obviously as we sell an investment, it kind of snowballs into us having to pay a little bit more in taxes. Okay, so what's actually going to happen as we sell $11,430 in investments within this taxable account, $8,572 of this is going to be cost basis. We're not going to owe any taxes on this. And note that I'm doing some slight rounding here just for easy numbers. So $8,572 of this is going to be your cost basis. You're not owing any taxes on that. Okay, if we have a 75% cost basis, that means 25% is going to be a taxable gain, a long-term capital gain here. And so this amount will be $2,858 given this example. Well, we're going to owe 15% on this amount. That translates to $430. So again, in order to pay $11,000 in conversion taxes, we're going to have to sell $11,430 and owe an additional $430 in long-term capital gain taxes. And so when we compare this to paying taxes out of the conversion, we can start to see where the magic of this situation happens, why it's more optimal to pay it out of a taxable account. So if we pay this $50,000, if we make this $50,000 conversion within the 22% bracket, and we're paying taxes out of the conversion, we're obviously going to owe $11,000, which means we're only actually going to convert here $39,000. Well, we just walked through the exact situation right here of paying it out of this taxable account with a 75% cost basis. Okay, in this example, we're able to fully convert that full $50,000. So the full amount is moving into our Roth IRA, growing tax protected for the future. Now our taxable account withdrawal is going to be $11,430. $430 is going to be the extra tax owed because of that taxable account withdrawal. The $11,000 then is going to be that same $11,000 we're going to owe in taxes on the conversion. Now, if you step back for a second and you notice here, there's a lot of different things going on within this equation. Obviously, in this example, we're only converting $39,000 versus in this example, we're converting a whole $50,000. But notice we're also paying a little bit more in taxes over here too. So how much more optimal is this? Well, the only thing that's being equalized out in this situation is $50,000 is leaving from your tax deferred account. Okay, that's the only thing that we see here. Again, we're making the same $50,000 overall conversion. $50,000 is leaving from your account. In one example, only $39,000 is actually going to your Roth IRA. In the other example, $50,000 is going into your Roth IRA. So how can we equalize this out more? Okay, well, what happens if we equalize out the taxes that we paid? For instance, we're converting a little bit more in this situation over here. I'm still making this extra conversion, even though in this example, I'm saying we're maxing out the 22% bracket. I'm still making this extra conversion here, taxed at 22%. So forgive me for that little adjustment here. But basically, if we were going to equalize out the $11,430 in taxes, it would allow us to convert a little bit more, about $1,500 more. Notice here, our taxes go up to $11,430. Over here, our taxes go up to $11,430. And again, this is a little bit more of an equalized situation, and we can start to see the benefit of paying the taxes out of this taxable account over here. Okay, we see here there's a $40,524 conversion that's ending up in your Roth IRA, growing for the future. Over here, again, we see that this full $50,000 is ending up being converted. And yes, our taxable account is going down, but remember, our taxable account is a little bit less of a tax preference account. So we don't mind paying taxes out of that account. Okay, let's talk about converting $50,000 to avoid IRMAA. So those that don't know, IRMAA is a Medicare penalty if you make too much. Okay, it's not based off your taxable income, it's based off your AGI. So you'd have to add back in the standard deduction to arrive at your AGI. Taxable income is after the standard deduction is taken out. Okay, now this is a 2-year look back, IRMAA is. So again, what you paid in taxes or what your income was in 2019 is going to affect what you pay in Medicare in 2021. So for a married couple filing jointly, you won't see any step up in IRMAA charges until your AGI is more than $176,000. At that point, you'll see there are different IRMAA step ups, different Medicare increases. So let's say we're converting $50,000 and we're trying to convert $50,000 right below that first IRMAA step up. Okay, so let's say that we're at $126,000 of AGI right now. And again, we see that we want to max out this IRMAA zone before we see an IRMAA step up. So we have $50,000 of extra room here. Well, if we think about this in terms of the conversion strategies, where we're going to pay those conversion taxes out of, how does this change or affect this situation? What does this all look like? Okay, well, again, if we're paying taxes out of that conversion, again, remember, we're paying $11,000 in taxes. So to convert and avoid that extra IRMAA step up, we're going to be converting $50,000. Okay. Well, over here, it means we're paying that $11,000 out of this conversion, and we're only ending up with a $39,000 conversion. Versus if we pay it out of that same example we talked about before, paying it out of our taxable account with a 75% cost basis, again, we're trying to add in $50,000 of AGI. Okay, this means in this situation, we're only going to be able to convert, rather than making that full $50,000 conversion, we're only making a conversion of $47,142. Okay, why is this? Well, again, if we look at this last scenario, and I know this can be confusing, okay, to pay this $11,430 in taxes, and again, it would be actually a little bit less because the conversion that we're making is not fully $50,000. But again, just bear with me again with a little bit of this rounding. I'm trying to make this math simple and rather than show completely different examples here and just kind of build on and layer on the complexity here. But if we're making that conversion, let's say again, we're pulling that same $11,430 from this taxable account. Again, the majority of this is our cost basis. So this is money that we can pull without any tax liability, without adding this into our AGI. The only amount that's being added into our AGI is $2,858. So again, when we're thinking about avoiding this IRMAA step up, we have $50,000 that we can add to our AGI before we see that IRMAA step up. Okay, in this example, 2,858 of this is going to be the long-term capital gains that we capture in order to pay the taxes, allowing us to convert $47,142. Okay, and I know, again, we're adding on complexities, adding on layers, and we can see how it gets more complex, but in every scenario, we see that more money is resulting in the conversion. More money is leaving less tax preference accounts and moving to a more tax preference account. So again, hopefully you're kind of seeing the value here in paying taxes out of a taxable account, whether you have to pay it out of cash or whether you have to sell an investment in order to pay those taxes. Now, for most people, the makeup of your taxable account is going to be very different. Okay, you're going to have different investments here. Some you might have, you might be holding in cash. You might be holding certain investments that have a large taxable gain, unrealized gain. You might have some investments that have a unrealized loss. Okay, you might have some stocks that you've held for 20 years that have a huge unrealized taxable gain. So the makeup of your taxable account will look drastically different from person to person. Let's take a hypothetical example here of somebody with $145,000 within their taxable account. I have the unrealized gain or loss here in parentheses. So this person has about $10,000 in cash. They have a few ETFs here with varying capital gains. One actually has a taxable loss here. And then they have a stock that is, again, they probably purchased quite a while ago originally with a $5,000 investment, and it's grown to $40,000. So it's had some serious growth over the years. So which asset should you sell in order to pay conversion taxes? And think to yourself, which asset would you sell of these to pay those conversion taxes? Okay, I'm guessing you said one of these five assets right here. And it's going to drastically depend on your situation. So you have to be thinking about your other goals here. Okay, we know that selling any of these investments makes more sense than paying the conversion taxes out of the conversion. But which of these assets makes the most sense in this given year to pay those conversion taxes will depend greatly on your situation, what these actual investments are, and your other goals. So for instance, if you're holding this cash as a cash buffer, or maybe you're making a short-term purchase that you're holding this cash in, the last thing you want to do is use that cash to pay conversion taxes. Because again, you're holding that cash for a specific reason. You're planning on using that within a couple months. You don't want to be using this to pay conversion taxes out of that. Okay? Selling each one of these. Should you sell a ETF that you have a smaller capital gain in, or should you sell a stock that you have a larger capital gain in? Well, again, what is the outlook on each of these investments? Is this stock right here something that you want to lower your over-concentration to? Is it something that's gotten too big of a position here? Well, then it might make sense, again, to sell something with a little bit larger of a capital gain. Obviously, that will change the math that we just went over. We were showing something with 75% cost basis. This is something with far less of a cost basis. So again, it will change the exact conversion calculation and change the math a little bit, but it still makes more sense to even something that has a large capital gain to sell that and pay taxes. Okay, what if you sell something with a loss? Okay, well, obviously that would actually lower, again, assuming you don't have any other gains or losses to offset. This is something where it could be offset against your ordinary income, meaning this $2,000 could offset $2,000 of your income. So this might make sense. It might not make sense if you still expect this ETF to bounce back and perform well. Okay, so which asset you sell in each given year to pay these conversion taxes will vary widely. Again, knowing which asset to sell is half of the game. Okay, and this is where I would recommend using experienced help, or if you're someone who DIYs this, think through this situation very thoroughly before you just have a gut reaction of selling the cash or selling something at a loss or selling something with a smaller capital gain. Any of these make sense. Some of these will make more sense in any given year based on your situation. Okay. The other thing to note as well, paying taxes out of a conversion, it's easy to withhold and send that money, that conversion tax withholding, sending it right to the government, and everything gets very simple. If you're paying taxes out of a taxable account, you have to make another step. You have to manually pay your taxes at the time of the conversion. We just released a video on this, on how to avoid underpayment penalties and pay taxes on the right timeline that the government sets out for you. I'll link to that in the upper right-hand corner. But again, if you're paying taxes out of a taxable account of any sort, you have to pay into the system on the right timeline. You can't just withhold these taxes and pay them April 15th the following tax year. Okay, you will likely be subject to underpayment penalties as well as potentially quarterly estimates going forward. So again, hopefully this was clear for you guys. Again, we added on layers of complexity, but the big message here that we tried to prove a few different ways is the optimal way to pay your Roth conversion taxes is out of your taxable account, whether you're paying it out of cash or you have to sell an asset. Okay. Hopefully this made sense. Let me know if you have any questions. Let me know if anything was confusing, and I'll try to answer those in the comments below. Always remember, you don't need more money. You need a better plan. Don't forget to hit the subscribe button. We look forward to seeing you in the next video. Have a great rest of the day.